Good morning, everyone. Welcome to another installment with Coffee with Carl. This morning, I have the pleasure of having Deron McCoy from Signature Estate and Investment Advisors, as well as SEIA. Deron oversees over $13 billion in client assets. Welcome, Deron.
Thanks for having me.
Well, thanks for joining this morning. What we're going to do is start off and talk a little bit about what we see in the market, some themes in general. For 2021. What themes do you see really leading the market moving forward?
There's a lot of themes. They tend to change every day if you're watching the media, but there's three big themes that are going to drive the whole year. One would be valuations. Everyone's talking about where we are. Is the stock market expensive? And we can dive into that. Obviously, the vaccine and what happened in November and the Georgia Senate runoff in January, that's kind of one theme, and how this economy starts to reopen later on in the year. And then the results of all that, maybe higher interest rates. So those are kind of the three themes that are driving our portfolio construction throughout really the back half of 2020 and then predominantly in it's a bigger theme here in 2021.
When you talk about valuations, how are you guys looking at the stock market now?
Well, if you're listening to satellite radio, you're scared, right? Everyone's talking about we're in another bubble or we're approaching another bubble, and valuations are certainly lofty, and that is certainly true. But the devil's kind of in the details here. So I don't know if we want to start off this chat with some math, but if you give me a couple seconds, I can kind of explain. What everyone's looking at is they're valuing the stock market on current earnings, whether it's 2020 or 2021 earnings, and on those measures, it's certainly elevated. But a global pandemic is kind of like a natural disaster. It comes through, it wreaks a bunch of havoc, but it goes away. And we've had global pandemics in the past, and it's a terrible health crisis right now, and it's getting worse here this month and next month. But ultimately, it goes away. And so, if you think of a storm or an earthquake, it comes in, it causes massive havoc, and you might actually lose some wages or a salary while you clean up, right? But you wouldn't want to measure your net worth and your future earnings based on that temporary blip during the cleanup. And so that's kind of what we're having today. You don't want to measure the stock market on 2020 earnings unless you think the global pandemic would last forever. We don't. And you don't want to really measure it on 2021 earnings because we're slowly getting out of this mess. And so if you take that aside and start to measure the stock market back on normal, quote unquote, normal earnings, maybe in 2022, it's not as expensive as everyone is leading you to believe. It's elevated, but we're not in bubble territory if you look at it from a longer term perspective.
Do you get concerned, if we were to start to run up another 10 to 15%, when it comes to that point? I guess the question is, how do you really start to position it? Is there a point where you guys say, hey, we really need to let their foot off the gas as far as taking on risk within your portfolios?
Right. And great point. Let me back up a little bit. There's certainly expensive assets out there, and there's certainly some stocks and some areas of the market that we wouldn't touch. They're just solely on momentum, solely on the fear of missing out, the greed type of aspect, and we certainly don't want to buy
GameStop, right? So no
GameStop, and everyone loves their mega cap growth, and everyone loves their Teslas and those types of names. But those are some areas of the market that are starting to get pretty rich. And even on 2021 earnings, 2022 earnings, and even for some 2030 earnings, it's just starting to get a little bit ludicrous. But there's much. The broader market isn't like that. So there's certainly areas of the market that we can rotate to that don't see those valuations that are actually in line with normal valuations over the last decade or so. So I'll give you an example. I mentioned based on 2022 earnings, let's use the S&P 500. It's certainly elevated, but it's not in bubble form. But if you look at an area like small cap value, it's completely in line with where it's traded the last 10, 20 years. And so if markets run up 10, 20%, certainly you want to take some profits and have some dry powder in case of another sell-off. We know that stocks will sell off 20% again. We'll have another bear market. We don't know when that's going to happen, but you do want some dry powder to be able to buy low. So you want to sell high, you want to buy low, you want to rotate and kind of reposition assets that kind of sidestep the expensive part of this conversation, but then has some tailwinds for maybe the second and third theme of this conversation. And so when you look at that, you're looking at, let me segue to theme 2 here, which is Biden and the vaccine. You have people from red states, you have people from blue states. 50% of America wasn't happy with the election. So we're not really talking about politics. We're talking about portfolio construction here and portfolio positioning and as an investor through a green lens, right? We just want to make money. And one of the big takeaways from November and the January runoff was that we didn't see a blue wave. Now we did see a blue sweep, but those two things are different. A blue wave, you have something like, say, 54, 55 senators, Democratic senators, with enough of a cushion to give some of those senators from red states some cover. And so you would then have more aggressive policies get through that would actually hurt corporate earnings. It might help the planet, and that's another conversation, but it would hurt corporate earnings. We didn't get that. We only have 50 Democrat senators. And so we're not going to get the most aggressive policies being pushed through Congress in the next couple of years. And so that's a big point. So now we have an environment where it's probably easier and more friendly on global trade. It's probably kind of right down the fairway in terms of a policy, not too aggressive, hurting corporate earnings. And so you see a lot of those types of sectors really starting to respond with the more stimulus, the reopening the economy, the vaccine coming. So you're kind of seeing a pivot away from the leaders of 2020, which was the work from home and the growth and the mega cap growth. And that's where the valuations come back into play, more towards the cyclical part of the economy, the reopening part of the economy, that the having fun part of the economy. And those types of stocks should probably do better here in 2021. So the leaders of last year probably aren't going to be the leaders of this year.
Yeah, I guess on that front, some of those leaders, are there anything you think about do you have anything in mind in particular? Would it be just value as a whole, or that small value, mid value, or international for that matter?
So sticking with the US, so we have a tailwind from valuations with I mentioned small cap value and value as a whole. And then when you look at the value sectors, what type of stocks make up value? It's the energy and commodity stocks, material stocks. And if you think we're going to get a lot of pent up demand in the back half of the year with people waiting to buy stuff that they couldn't do last year, you're probably going to have some inflation, or at least a get back to normal type of inflation. And so in an inflationary environment, commodity stocks, materials and energy should do pretty well. They've historically done well in the past. And then the companies that help those types of industries, the capital expenditures, the CapEx, those are mainly industrial companies. And so industrials should do well. And then if you have that pent up demand and you have all of this stimulus and you have the vaccine and the reopening of America and higher inflation, you probably will have higher interest rates. And so as interest rates move north in the coming quarters, not February, not March, but probably towards the back half of the year, you should have banks and financials start to do well. All four of those sectors, energy, materials, industrials, and financials, those are the big stalwarts of the value sector. So value starting to have a couple of different tailwinds here for the next couple of years and probably should outperform growth, which hasn't happened in a good long time. It's the mega cap growth that's really been driving the train here lately.
Yeah, you mentioned higher interest rates. Is that, I guess, when does it, on your end, how do you combat that? How are you trying to position portfolios portfolios? And are you concerned about a rapid level of inflation, or a pretty slow, gradual pace over the next couple of years?
Great question. And again, I think there's a lot of fear mongering out there that with all this stimulus and the money out there, that we're going to get higher inflation, materially higher inflation that we haven't seen in decades. We view it more as a get back to normal type of trade, type of environment. And so, we'll still have high unemployment. We still have a lot of debt. We still have the demographics and the deflationary aspect of tech. And so that's going to keep a lid on inflation, but you're definitely going to move it higher than where it's been. And so as we get back to normal, we need to remember where normal was. And normal before COVID, inflation was barely running around 2%. So can we get to 2.5, 3? Yeah, maybe, perhaps. But we're not going to get to 6, 7, 8% inflation that people are starting to really fear, and which would drive interest rates, materially higher. We don't think that's going to happen, but just more of a get back to normal type of trade, which sounds kind of logical, but the first half of 2020 wasn't logical. 2020 as a whole, was very unique, and so investors around the globe migrated towards those mission critical, essential assets that you had to have to make this kind of conversation happen, right? Which those are typically growth assets. They're typically large cap because you have to have scale to reach the masses. And thanks to Silicon Valley and some other tech hubs around the country, they're typically US. And so US large cap growth did really well. But as work from home starts to take a back seat, at least at the margin, I don't think it's going away. But at the margin, it will get less of a desire. And so those other assets will start to outperform. So you have a lot of tailwinds here of those cyclical value type sectors leading the US. And so another segue off that is overseas should do pretty well here also. So if you look at the sector makeup of the S&P, the energy, the materials, the industrials, and the financials, more of overseas indices, they're more cyclical. They have more value. US is kind of typically more of a growth market because of Silicon Valley and whatnot. So overseas should do well because they have those types of assets. And you have a friendlier tone perhaps out of Washington, DC. We're not going to wake up at 4 a.m. with a new tariff or whatever. And then with all of this stimulus and all of this, money through the system, you might have that dollar continue to weaken, the US dollar, which means assets overseas would appreciate. And so we think not only value here in the US, but value in an appreciating currency in Europe, or value in appreciating currency in Japan should do well also.
Yes, you mentioned Europe. So, Europe has been one of those areas that really hasn't done much for many years over now. Do you finally see that as being an opportunity to invest overseas other than just Asia, for that matter?
Right. It's for sure Europe is underperformed and Japan's underperformed for seemingly forever. But for US investors, Japan just hit a 30-year high. I don't think that's really appreciated by the market. And so overseas is not only, I think, going to outperform here, it's already started to happen. They outperformed in Q4. So the trend is already changing. The question is just how long is it going to last? And with the view of what we see in the market and those tailwinds of those sectors, it probably has a good while here of outperforming. And if you look at past cycles, the US versus international has been like a decade type of a cycle. I'm not here to say that they're going to outperform for the next 10 years, but we're going to ride it for a good long time. And back to your Europe question, if you take out the FANGs out of the US and maybe Tesla, if you take out those mega cap growth stocks, Europe and the US have kind of traded pretty closely, but it's just been that dominant performance out of that mega cap growth the trillion-dollar companies. I think Apple's now $2.4 trillion. That's been driving the train here in the U.S. But if you take those out, Europe and the U.S. have been performed quite similarly. So again, we think that growth there, it starts to underperform. So we think Europe, by the math, addition by subtraction, we think Europe can do well here.
And you made an interesting point. You're mentioning the mega cap stocks leading the market, which in turn, to me, they obviously make up a large chunk of the S&P 500 index. How are you looking at investing, now? The index funds have done extremely well, comparative to a lot of mutual funds. Are you starting to make that shift more towards active management, since, a large chunk in those big tech companies, if they start to pull back, it could really hurt the overall performance of the index funds as a whole?
You're absolutely right. You can tackle that a couple different ways. One is you can choose an active manager to kind of sidestep those expensive stocks. And I'll use, you don't have to use Tesla or GameStop. We can use Apple. Everyone owns and loves Apple. But Apple is approaching a 40x PE, which is rich. And so if investors then decide that a 30 multiple is more appropriate, you just had Apple lose 25% with the underlying company, unchanged, completely doing fine. So there's risk there. It's not a bubble. I don't think you're going to get a permanent impairment of capital out of Apple for the next 20 years, but it could certainly underperform. So again, can Apple go from 2.4 trillion to 4.8 trillion? Can it double? The law of large numbers, the math starts to get hard. So you can either use an active manager to kind of try to sidestep those expensive assets, or you can simply add in other indices to your S&P 500 fund. So, take some profits and add in maybe a small cap fund, maybe a small cap value fund, add in some overseas. And we haven't talked about emerging markets yet. They've shown some real growth and real resilience, especially in the Far East. And so you can still have an indexed type of approach, but make sure not all of your money is in that S&P 500 index.
And I think that's a great point. And for a lot of the viewers of this, you'll see when I do the 401ks or individual meetings, you'll come across just everything in the S&P 500. So, really diversifying out of that, I think makes a lot of sense.
Right. Right. Probably not go to zero. We're not predicting an imminent crash. It's getting frothy. Valuations are getting elevated, but I don't think we're in bubble territory yet. But that's something that's the big risk for 2021, and we're mindful of. But take some profits. It's been the big winner, and reallocate around the world to other assets that are cheap. It makes a lot of sense, and you'll probably wake up in 2025 pretty happy that you did.
No, great point. I guess one last question. You mentioned potentially reallocating. When I think about fixed income, a lot of times that becomes a placeholder for some people saying, hey, I want to have this conservative asset class. If we do see rising interest rates, how do you look at fixed income? What is your approach? Are you indexing, are you active managing, and how are you trying to combat potentially rising interest rates?
Great question. And the real crux of the question is actually in the name, fixed income. We don't like fixed income. We like bonds, but we call it unfixed income. And so it's kind of the opposite of a mortgage. Right now, you want to refinance and lock in a low rate. But if you're buying bonds, you want to do the opposite. You don't want to lock in low rates right now. And so you want bonds to have their coupon, to have the income stream actually float as interest rates move higher. And you can tackle that a couple of different ways. But what we don't want to do is go out and buy the best performing asset of one of the best performing assets of 2020 was 30-year zero coupon treasuries, right? Unless you think the pandemic is going to happen again or another worldwide crisis is going to happen again, those types of returns aren't going to repeat themselves in 2021, especially when yields are half what they were in 2019. Mm-hmm. So rates are moving higher. returns are going to be less. But if you reposition your fixed income into unfixed income, you can still have that stay rich type of asset that can then be used to buy low in case we do have a sell-off.
Do you have an example of that, maybe like floating rate or something that people can look into?
Sure. So the easiest example is you can either have a 10-year treasury at 1% coupon, or you can have a 10-year treasury that's tied to inflation. So as inflation moves higher, the price and the coupon, you get a little bit more income. So that's kind of the plain vanilla version. Fixed rate treasuries or treasuries tied to CPI, inflation. And then it gets, as you move beyond treasuries, you have a lot more choices. So, Apple can issue a fixed rate bond, or they can issue a bond tied to some floating interest rate. And, or you can invest in mortgages. So there's 30-year fixed rate mortgages, or there's 10-1 adjustable arms or HELOCs where the interest rate floats along. So there's a lot of different instruments in the bond market, and not all of them have a fixed coupon.
That makes sense. One point that I've had a lot of clients ask about recently is just real estate investments. And given the if interest rates start to go up, potentially looking into that space. How do you guys look at real estate now? And is it an area that's concerning? Obviously with the commercial backdrop.
So if interest rates are going to go up, we will probably see inflation move higher.
Yep.
And so if you look at inflation, one of the biggest components of it is rents.
Yep.
And so that can be rents in your home. It can be rents in real estate. And so if rents are moving higher, inflation is moving higher, interest rates are moving higher. But back up to the beginning, if rents are moving higher and you own that real estate, that means your income stream is moving higher as well. Mm-hmm. So that's an example of an asset that has an unfixed coupon, an unfixed earnings stream, that where in an inflationary or higher interest rate environment, you can actually have that asset appreciate because the underlying income is appreciating as well. What we need to be mindful of is we want to own the real estate where the rents are increasing, right?
Yeah,
and so the past 12 months, as malls closed, as everyone moved to online retail, you didn't really want to own a brick and mortar. You didn't want to own the real estate underneath the Macy's. You didn't want to own the real estate underneath the Cheesecake Factory, right? You wanted to own the real estate that had the Amazon farm or the Walmart distribution center, something like that. So focus on the real estate that's going to be here in 2 years and 3 years and 4 years, and then have that underlying income ratchet higher as America kind of reopens.
Perfect. Good point. Any other points that you might want to throw out to the audience before we finish up today?
Well, it's kind of just hammering home what we've just said. The leaders of 2020, we don't think are going to be the leaders of 2021. And that falls into mega cap growth, and that falls into long-term treasuries, because the themes and the tailwinds have changed. And they've changed because the Washington, D.C. and the pandemic has changed. And so there's reasons for this change. And so a lot of these tailwinds are lining up to have the next couple of years be polar opposite of the last couple of years. And so again, don't liquidate that mega cap growth. I know you love your Apple and your Tesla and everything else, but take some profits and reallocate into some areas that have a lot of tailwinds here, especially moving into 2022.
Perfect. Thank you, Darren. That's very, very helpful. So for the audience, appreciate you guys listening in. If you guys do have any questions, certainly don't hesitate to reach out to myself. Darren's always glad to be a resource for us as well. Thanks for everyone's time, and Darren, most importantly, thank you. I appreciate it. Have a great day.